Common Sense Investing Part 5, Rule 4 for Successful Investing. In the last video we learnt about durable competitive businesses with an economic moat and their advantages. In this video we will go through the fourth rule for successful investing. Rule 4, business must have good financials. After selecting the business with good long-term prospects, it is important to go through the financials before investing in the business. Here are the 5 important financials which one has to look for in the company's financial statements: growth in sales, growth in net profit, consistency or growth in net profit margins, low long-term debt-to-equity ratio, consistency or growth in return on equity. We will be going through each of them in much detail with examples from financials of Britannia Industries. 1. Sales. Sales is the primary source of revenue generation for the company. Sales also turns out to be the major source of revenue unlike other incomes. Therefore, increase in sales indicates better business prospects and it helps the company to become more profitable. For Britannia, the sales have grown from 4,620 crores in 2011 to 7,940 crores in 2015. Constituting 11.4% CAGR. 2. PAT. PAT stands for profit after tax. It is also the net profit of the company. Good growth in net profit also suggests that company has done substantially well in its operations that has led to good overall growth of the company. Net profit growing faster than sales indicates that the company has managed to increase the profit margins significantly. The net profit for Britannia has grown from 134 crores in 2011 to 688 crores in 2015, constituting a 38.7% compounded growth. The net profit for Britannia has grown thrice faster than sales. This indicates that Britannia is able to increase its margins significantly. 3. Net profit margin. It can be defined as total net profit for 100 rupees sales. Maintaining a consistent net profit margin is extremely important for a company. Even in case of a good growth in sales, the company can make very little profit because of the contraction in the profit margins. Britannia has managed to expand its margins rapidly. The net profit margin, which was 2.91% in 2011, has been expanded to 8.76% in 2015. This is possible because Britannia is a durable competitive business having an economic moat. 4. Long-term debt-to-equity ratio. Debt-to-equity ratio compares long-term debts to shareholders' equity. Higher debt means higher the external liability for the company, and most of the generated revenues or cash will be used up to clear the debts and to pay the interest on loans. If the debt is higher than the equity, it can lead to insolvency where the company will not be able to clear its debts even after liquidating all its assets. Therefore, debt to equity is a very important solvency ratio that determines the financial health of the company. Britannia has able to bring down its long-term debt-to-equity ratio from 1.46 in 2011 to 0.04 in 2015, which is a result of increase in equity and reduction in debt of the company. This dip in debt-to-equity ratio suggests that the company has good financial health. 5. Return on equity. Return on equity is a profitability ratio that indicates how profitable is the company by comparing the net income with the shareholders' equity. Return on equity measures the rate of return the investor has earned for their investments in the company. Higher ratio indicates that the investors have managed to earn more on their investment in the company. For Britannia in 2011 the ROE was 41.2%, whereas in 2015 the ROE is 55.4%. Indicating, Britannia is consistent in offering good rate of return on shareholders' equity. Finally, covering this in a nutshell. Generally, business with good long-term prospects tends to have good financials too. But before investing, it is important to scrutinize through few key financials of the company, and they are: growth in sales, growth in net profit, consistency or growth in net profit margins, low long-term debt-to-equity ratio, consistency or growth in return on equity. Here we come to the end of this video. Please like and subscribe. Thank you.